There's a lot of options being traded, though, to be real. Regretti's trading more options than Microsoft. Tell me that's not a bubble.
Order partially filled.
Tell me that's not a
Order
bubble.
filled.
Do you know the scene when the black dude is really angry at one guy, then he's really angry at another dude, and he lets the other dude go? He's like, we're cool. So to me, AVXL is like the stock I'm going to let go away. Like, we're cool. My issues with quantum. I'll get to AVXL later. I got to worry about this quantum right now. We're cool, AVXL? We're cool, bro. I'm not in QSI. Wasn't QSI up like 30% a minute ago? Yo, this is nuts. This isn't trading. This is memes.
Order cancelled.
This makes
Order
making
filled.
the U.S. stock market fartcoin overnight. I have to ask my dentist, can I take out all this dental work, sell it, buy some Regretti puts? I'll see you next week. I'll pay you straight cash, bro. I got you. I told you. Come on, bro.
Order partially filled.
You're Shkreli, baby. Come on, man. Come on, man. Don't do me like that. Need it till next week. Regretti's going to be down next week, bro. Of course, Regretti had a little bounce there. But this is where you put out, if you were buying hedges, now you can sell some stock against or delever. And you're just trying to keep the bid-ask. You don't want to lose money on bid-ask crossings, if that makes sense. But you're trying to take advantage of volatility instead of having it take advantage of you. Now, you're always going to have some directional angle. Some people don't. Market makers don't. As it rallies a little, I might want to sell some of my hedges. And if it dips, I'll buy some back. That's kind of the idea. And I get to roll. Different strikes have different deltas. So right now, little bump, you might want to sell your high deltas. And on a dip, you might want to buy your low deltas. And of course, you have common stock as a tool. Again, it's not going to save your, well, depending on how you set your hedges up. So to give you a concrete example, I guess I can try to give you a concrete example. I'll sort of try to do the math on the fly, but let's say Regretti is 18.35, which is the current price. Regretti 17 calls, they're about to expire, right? They'll be trading at 135 to, and they'll update, so when this is 139, fair value of this should be 139. When it's 1839, should be 110. That sort of makes sense, right? So you have to sort of play these values against each other. So now we're short Regretti. Let's say we're short 1,000 shares at 1839. That's $18,390. Let's say we're long these 17 calls. I don't know. Let's say we're long 5 calls. That makes sense. That's 500 shares notional. And so that's $1. Say we bought that for $1.35. Well, this is what, 5 times 135. 675. That's right. 500 times 17. Well, yeah, I guess we could just do the value, I guess. $675. So every dollar Regretti goes up, this should go up $1 too, because this is in essence, a 100% delta, right? So if Regretti goes up 1939, you lose $1,000 on that. But you would, this would be, you would lose $500. You would make $500 on this, so you would net lose. But at that price, maybe you'd want to say, you know what, I'll sell these. So sold 5 calls. Book $500 profit, and because this is so volatile, maybe you'll get another chance to buy this hedge back down here. Bought these.
Order filled.
And, ideally you can have some volatility will help you get out of your position. Now, let's say you round trip this to this twice.
Order filled.
Well, now, you have basically have these calls for free, if that makes sense. Now, it's options expiry, so delta's 100. It's not 100 when it's not options expiry. So these things will move less because there's less expiry. They'll move less depending on their delta. There's a lot to it, but the basic idea of being a vol trader is that. Now, we have a directional bet, but it doesn't mean we can't make some money on the vol as well. And it could slightly offset the losses from the vol, and from the direction. And huge amounts of volatility is sort of a trader's best friend. You have a lot of options. If I luckily put on some hedges earlier in the 18 range, those hedges are up a lot in some cases. So you sell them and now you're back to short position. Now, whether or not you'll be able to buy them back again depends, and you have to have a nose for it. It's certainly not easy. A little bit of luck helps too, but we obviously want the market to drop for these stocks. But even trading small amounts of hedges can add a little profit to your mix, and it's not gonna, like I said, it's gonna soften a blow. You're not gonna be happy about it, but you're fighting to stay in the short another day. Every day you get to stay in the short, you get to hopefully get that big downside when the crash happens. IonQ was up 10% for no reason. Regretti was up 25% yesterday for no reason. $11 a week ago. 11. 19 right now. 14 just 3 or 4 sessions ago. No news. Nothing has changed. Google Quantum is interesting, but like I said, even people at Google Quantum are skeptical. Google PR team just kind of hit it out of the park with this one. The whole internet talking about parallel universes. Like, what? I showed you the factoring. We factored, what do we factor, 15 into 3 and 5? Other concept, just so everybody understands how the hedging strategy works. I think I went over this, we'll just go over it again. Let's say you're long, let's say you're short 10,000 shares of IonQ, 47.28. What is that? $470,280. Pick a different portfolio size. A little bigger than last time. Some of you have big portfolios, some of you have small portfolios. Doesn't really matter. You want to hedge this, or maybe you don't have the margin for this. Either way, you say, you know what, I'll go long exactly 100 IonQ calls, the 35 calls that expire next week, okay? And those should be priced at, what, $12.20. Now, maybe you have to pay $12.30 because you're crossing the bid-ask, or there's some implied vol. There shouldn't be much implied vol this deep in the money. Let's say there is. And you're paying $12.20 or $12.30. 2 cents of implied vol, not much. And again, we have, well, we could do the math on this. This is $1,230 times 100. So 1230 and 2 zeros. So you're long that much. Okay. Now, do you know what the profit payout for this is? Again, you can use an options calculator or do it in Excel yourself. But basically, what happens if the stock goes to, say, 30?
Order filled.
Now, will IonQ go to 30? You know, that doesn't necessarily seem like likely to happen, but you basically get kind of this free short. So this part, right, well, we know how to do this. At 30, this is $300,000, so you made $172,280. Your long calls are worthless, right? Your calls are worth nothing. Now, depending on the day that trade, potentially that stock drops, you could have some residual value on those calls, theoretically. But let's assume it's worth nothing. And so in this case, you lose $123,000 and on the calls, but you made 170 on the short, so you netted out 53K. Now, what happens if the stock goes to 60, which, given this rally, we know might and could happen? Well, let's take a look. At 60, you've lost a lot of money. You've lost $130,000 roughly. But your calls went up. That's on your common stock. On your calls, what are your 35 calls worth at 60? They're worth $25. That's $250,000. You bought those for $123,000. So you're up 130. You didn't lose any money at all. Not bad. So now the stock has to get creamed for you to make any money here. The stock may not get creamed. But what if this was at $40 or $45 or $43? And you have to run the math on those. And you can kind of get some outsized downside without having a big upside risk. But in general, it's going to be very hard to do. There's no free lunch in the markets, right? There's no free lunch at all. There never has been, never will be. But depending on what it is what bet you're trying to make, you can kind of make them happen. You had a small rally in these stocks, good time to sell some of the hedges you bought. It was back down, you can buy them back. Occasionally, hedges that you really didn't expect to be worth anything end up worth a lot. Like today, I had these IonQ 45 calls that were like 10 cents or 20 cents yesterday. As you would expect, the stock was like 43 or 42. Why would the 45 calls be worth anything? Well, they were 25 cents yesterday. they're like $2 or $3. And I was able to sell those, which gave me enough profit to not get totally annihilated today. Now, you do limit your upside. If the stock drops a little bit, you still don't make tons of money. But you can mix and match these hedges. You don't have to have them all in the same strike price.
Order filled.
You can have some at this strike, some at that strike. And you can kind of keep rolling it as you see fit. So I sometimes call this taming the beast, but for now, the beast sure tamed me. But
order filled.
You know, if you can hold on, hang tough, you might be able to do it. The bid-ask spread in the calls and puts is what Jane Street and 𝗔𝗥𝗧𝗏 and Susquehanna and Citadel, that's where they win. For example, if you're bullish on IonQ, they will sell you an option that's maybe 5 or 10 cents too pricey. And they'll go delta hedge. They'll do exactly what I just showed you on that screen to avoid losing money. The only way they can lose money is if there's a really crazy event. And the way they do that is they delta hedge. So there's 5% chance that happens, well, I'll short 5% of the stock. And that's where you guys hear about gamma squeezes and stuff like that. You can sort of artificially induce the market maker to take a directional bet that they don't want to take by buying really out of the money calls. Yeah, I do expect them to kind of gap down at some point. We've seen this before. I think all of you have seen that before. Yeah, I want to roll some hedges and put some on, but I don't. The higher the strike price, the more implied vol you got to pay. The lower the strike price, the less implied vol you got to pay. So you can kind of SLS. Okay, so SLS. Oh, this is an opportunity, probably a better opportunity than Regretti or IonQ. Maybe not as unprecedented, but probably more up most people's alleys. Yeah, well, it's not perfect because it's a really small cap company. And we saw with gold that and even right now at the price that SAVA is at, when you deal with these really small market caps, they don't necessarily behave normally because less money is needed to move them. Having said that, money is still money. So it's not like just because there's less money involved doesn't mean that people aren't going to care about their money. They do. But it's something to be mindful of. Some people avoid these market caps. I don't think you have to be partially filled. I don't think you have to be too afraid of them.
Order filled.
So anyway, they have one drug. Oh, well, actually they have two drugs. But I think most people think most of the value is this one drug called Galinpepimut. This drug is for the worst disease ever. Called AML. AML, acute myeloid leukemia, or acute myelogenous leukemia. This is a really, really tough hematological malignancy, one of the worst blood cancers you can get. And what's interesting about this blood cancer, so for those of you who don't know, most of these blood cancers, there's basically something goes wrong with your bone marrow. And there's some kind of certainly in AML and in many others, there's some kind of marrow cell that's mutated and is going to keep replicating. If you're familiar with how blood cells work, there's like a central lineage that are progenitor cells of the downstream blood cells. So they're like father cells in essence, sometimes called stem cells. And these stem cells differentiate into different cell types. So if you have a mutation in your stem cell, you're going to have a problem with all of the cells that get created from that stem cell template. So sometimes called as a clonal system, because these cells are clones of their parent cells. So in AML, the only thing that seems to work, and it doesn't work very well, it works briefly, is you blast the bone marrow. You just kill everything. You kill all the cells. And there are chemos that work that are more or less specific to just blood cells. So with these chemos, you just can irradiate and destroy the bone marrow. Maybe not irradiate, but deplete the bone marrow quite a bit. This is sometimes called myelodepletion or myelosuppression. And you hope that when the marrow grows back, or the blood grows back, that the cancer's not there. Now, obviously, you still have this problem where there's some mutation somewhere that's causing this issue. So what ends up happening is you can get something called a CR, which is in cancer, as you guys may know, a complete response. You want a complete response. It's a good thing to have a CR. The problem is that you're going to have, so let's say here's your bone marrow niche, and you sort of have this healthy stem cell, healthy stem cell, healthy stem cell, healthy stem cell, cancer stem cell. Now this guy sort of outcompetes. He multiplies a lot more. So when you look outside the bone marrow into the blood, you might see actually more red guys than green guys. You might say, okay, wow, there's a lot of cancer here. There's a couple of green guys too. But the person's having anemia, they're having infections, they're having all kinds of problems because their blood's not working. It's filled with these red guys, which are the cancer cell. So now you wipe out this bone marrow. You wipe out the blood cells and the bone marrow, right? And you end up, it's going to kind of grow back. But immediately, at least, it's going to sort of still be mostly green in the bloodstream. And eventually, the reds start to show up, and the reds take over. It sort of slowly comes out, and more and more and more. And then the reds are all there again. And the complete response is gone. Your CR, this is called CR1, is gone. Now you can just do it again, right? And that's called CR2. So these guys have a drug for CR2 in AML, which is one of the worst illnesses you could have in human existence, because you've already had a bone marrow wipe, if you will, formatted the hard drive, and you're still, you had the cancer come back, then you wiped it again, and you're hoping the cancer is not going to come back, but it's going to. And typically what ends up happening in these things is the amount of time it takes for the cancer to come back shortens and shortens and shortens. And you could even get to CR3 if you're lucky. But inevitably, it's really hard and the cancer takes over. So these guys have a drug that will extend your time in CR2, but it doesn't work, and it's not going to work. And the company is kind of this like really dumb small cap company that's just been kind of extending their death over and over and over again. Quite frankly, not sure how many shares outstanding they have, but the cash is down to 21 million. They have payables. So when you deal with these really small companies, payables actually matter quite a lot. We don't pay much attention to them for the bigger companies. But the reality is, like, if they owe their lawyers money, that is debt, right? If they owe their clinical trial sites money, that is debt. So like arguably these are like debt-like for companies like this. We don't care really for other companies because they have accounts receivable, they have inventories, they have other stuff like that, or it's not material. In this case, it is. You know, they basically have no cash because they don't sell a product or anything. So they don't have any accounts receivable. They don't sell a product. They don't have any inventory. So they don't have anything coming in on the income statement side where we can ignore those liabilities. And again, we generally gloss over it because it makes sense to generally gloss over it. We don't really care about Apple's payables because Apple probably has receivables too. And their working capital is basically balanced. Even if it wasn't, Apple's not going to make, the working capital of Apple's not going to make a difference to the value of Apple. So just something to kind of keep in mind there, that when you're dealing with really small companies, like these guys need capital to pay their bills. And they owe their vendors. They got to pay the vendors. The vendors aren't going to do work unless they get paid. Without the work, there's no 10Q, there's no 10K, there's no legal arrangements. There's not, you know, it's all over. So I think it's all over for these guys, basically. But, you know, the stock still trades. There's a hope that this is a cure for AML, or a treatment for AML, I should say. But this trial Regal is coming out soon. It's very, very, very hard to imagine that this could work. They would have to double the survival using this drug. Somebody else made a drug like this once, and it did not work. In fact, this mechanism has been shown to really not be that relevant, in my opinion, in this disease, because these aren't people that have, in cancer, what works really well is when you have a mechanism that's tailored to the disease. And that's not really the case here. You know, in EGFR mutated non-small cell lung cancer, you can feel somewhat comfortable, but that approach makes sense because you're attacking the actual mutation the human being has. That is a smart idea. That is what's wrong with the patient. In AML, all kinds of things are wrong. There's all kinds of mutations. It's not just one mutation. So, this was the competitor. And you see this data is really bad. The Kaplan-Meier crosses to 3 times, right? 1, 2, I guess twice. But still, the p-value is 0.74. It's not clear. Can you see this without the labeling? Which group is better? Which would you rather be? Every time the thing goes down, somebody dies. Would you rather be in the solid black line or the dotted white line or the dotted black line? They look the same to me. And the statistics show that they are the same, 0.85. So this is basically the same drug. And this was done by a bigger pharma company. It did not work. So how is this thing going to work? Well, some of the bulls say, well, they're technically not exactly the same. Sure, they're not exactly the same, but come on, dog. EGFR inhibitors, there's the 1st generation, 2nd generation, 3rd generation. We're on 4th generation now. We're always trying to improve the EGFR inhibitors, but they work fundamentally. You know, tweaking this approach, in my opinion, if this was useful, it would have worked anyway. What's up, Medicine Investor? The WT1 approach just doesn't make that much sense clinically. It hasn't worked clinically. And it's pretty far afield from the actual tumor problem. It's not even clear if you want to do it. So the other problem here is it's a cancer vaccine. Cancer vaccines have never worked either. Now, I'll never say never. CADL sort of proved that. CADL had a kind of good result, mixed result, depending on how you look at it. Some people say it was good. This was their binary. It's very odd. It was like a binary event where the stock didn't really go up that much. But, you know, the stock's doubled. And that was a weird gene therapy, kind of just bizarre type of treatment. And they had good results. So some people quibble about those results, but, you know, it worked, it looks like. So, you know, I think there's a lot to, you know, be cautious about in any binary event. You don't know what the future holds, but SLS really looks like it's not legitimate. I think one of the bigger problems is this company has avoided putting these results out for a really long time. That could be completely innocent, or it can be completely shady. And when it comes to your money, you got to be pretty careful that it's not shady. So it seems to me like there's a serious risk that these guys are kind of trying to play hide the potato. Now they're also trying to pivot to this other drug, which doesn't look too valuable, but they're trying to sort of say, oh, well, that's our new drug. I don't think that's going to work. I think when they put out these results, it's going to go down. But